If I had to read these markets today from scratch, knowing what I know about how gold, silver, and oil behave when fear, momentum, and bad interpretation all collide at the same time, I would do this very differently. Most people think market analysis is about finding one level, one headline, one perfect call, and then pounding the table like the future just sent you a private text message. But that's not what this is anymore. We're in one of those stretches where the loudest people are usually reacting to the last move, while the chart is quietly setting up the next one. And right now, the bigger message is uncomfortable. Gold may still have room to run before it turns lower. Silver may still squeeze before it slips. And oil, despite the drama, still looks vulnerable once the bounce traders finish chasing shadows. Today is Thursday, April 16th in New York, so comment the day and date you're watching from. And real quick, if you value the work I put into these breakdowns, subscribe and comment John A.G. Best so I know you're here and I know you want more of this. Now let's get into this, because the trap here is not direction. The trap is sequence. People hear that gold could go lower later and they immediately assume it has to drop right now. They hear silver still looks risky and they assume every bounce is fake. They hear oil has downside targets and they think that means the market can't rally in between. That is not how this game works. Markets love to fake the obvious. They love to lean one way, pull the crowd in, and only then reveal the move that actually matters. So let's start with gold, because this is where the setup gets really interesting. The case here is not that gold has lost its long-term strength. The case is that the chart may still be finishing an upside move into a major target zone before the larger corrective phase resumes. That distinction matters a lot, because a rally does not automatically cancel a bearish structure. Sometimes the rally is the last beautiful piece of the bearish structure. When I'm looking at gold, I'm not just staring at price and hoping inspiration arrives. I'm looking at repeated slopes, prior reaction zones, and the way old ceilings can become floors and then later become magnets again when price swings back into them. Markets remember where the battle happened. They remember where buyers got rewarded, where sellers got trapped, and where the move first started to lose oxygen. That memory is not magic, but it matters. And from that angle, the path that still makes the most sense to me is one more push toward the big round area, around 5,000, maybe a touch above that zone if momentum stretches just a bit more. The reason that matters is not because round numbers are mystical. It's because that zone appears to line up with prior structure, with repeated geometry, and with the kind of confluence traders watch when a market has unfinished business overhead. Now here's where the fresh context comes in. Gold has already rebounded back toward the upper 4,000s this week after finding buyers again, and spot prices were trading around the high 4,800s on Thursday. That tells you something important. It tells you buyers are still active on dips, and it tells you the market has not abandoned the upside story just because volatility picked up in recent weeks. At the same time, the latest Federal Reserve statement showed policymakers held rates steady in March and emphasized uncertainty around the outlook, which means the macro backdrop still leaves room for gold to remain supported if rate cut hopes revive, or if geopolitical stress refuses to cool off. But this is also where I want to challenge the easy narrative. A lot of traders talk as if every gold rally automatically proves the bull case and every gold dip automatically proves manipulation. I don't buy either shortcut. Gold can be fundamentally strong and still technically vulnerable. Both things can be true. In fact, some of the strongest markets still go through hard, ugly corrective phases that shake out the late crowd before the real, longer-term advance is ready. So if gold does press into that big target area, the next question becomes, what happens after the applause? And my answer is this. If the broader structure remains intact, then the market can still roll back toward the upper 3,000 region first, and maybe even probe lower before the next much cleaner, major bullish leg is ready. In other words, the market could still reward the bulls first and punish the late bulls second. That is a very normal thing in real life, even though it feels outrageous in the moment. And before anyone gets too dogmatic, let me say this clearly. Charts are powerful, but they are not holy scripture. They don't have feelings. They don't have agendas. And that's exactly why they're useful. But they are still probability tools. They can fail when news, policy, war, or liquidity shocks hit the tape. So yes, trust structure more than social media noise. Just don't turn technical analysis into a religion, because the moment you start worshiping your chart is usually the moment the market humbles you. Now silver. Silver is where people get emotional fast, because silver never seems satisfied with a simple move. It has to overshoot. It has to trap somebody. It has to create just enough drama to make both sides feel smart before one side gets destroyed. And right now, silver still looks like a market that can make one more run into resistance before the deeper problem shows up. The obvious area everybody's watching is the low 80s. That's the nearby ceiling. That's the zone where people will start screaming breakout if price pushes hard enough. And yes, silver could absolutely tag that area, maybe even pop through it a little before the larger downside leg comes into view again. If you assume resistance has to hold perfectly on first touch, silver is one of those markets that loves proving you wrong. Underneath that, the market has been respecting support in the mid-60s, and that lower shelf is what gives the current shape its tension. You had the drop, then the flattening action, then the slight upward lean, and that kind of pattern can absolutely generate one more upside shove before the next real drop. So again, the question is not just direction, it's sequence. Now, based on recently published industry research, silver is still headed for another year of structural deficit, which would make it roughly the sixth straight year of shortfall. Supply is projected to slip a little, coin and bar investment is expected to recover, and above-ground inventories have already been drawn down significantly over the last several years. That is real support for the bullish argument, and anyone pretending it doesn't matter is not being serious. But here's the other side, and this is why I'm not blindly joining the silver parade. The same research also points to weaker industrial demand this year, with fabrication demand expected to soften under pressure from the weaker global economy. And if growth slows while volatility rises, silver can still sell off hard even with a deficit in place, because deficits do not immunize a market from liquidation. They just change how explosive the rebounds can be later. The IMF's latest global outlook also says growth is expected to slow this year while headline inflation rises modestly, which is exactly the kind of messy backdrop that can create both safe haven buying and industrial demand anxiety at the same time. That's why I think the smarter read is this. Silver may still have enough fuel for a final squeeze toward or slightly through resistance, but if the larger pattern keeps unfolding, the market can still work its way down toward the general 50 area later on, possibly around the middle of the year, if time and structure keep syncing up. That is not a tiny move. That is the kind of move that makes people realize they were trading a story while the market was trading a roadmap. And this is where discipline matters more than opinion. Stop asking the market to validate your position. If you own a mountain of silver, you'll find a reason to call every chart bullish. If you're short, you'll find a reason to dismiss every rally as a joke. That's not analysis, that's attachment. And attachment is expensive. If you're successful, share your success story in the comments so others can stay motivated. Now let's talk about oil, because this one has been a masterclass in how headlines can overpower people's judgment. You've had war risk, supply disruption, shipping stress, inflation concerns, and enough emotional noise to make traders think price had to go straight up forever. And yet the structure is still flashing something more cautious than the headline crowd wanted to admit. The key issue for oil is that the market appears to have already cracked an upward sloping support structure and then started forming behavior that looks a lot more like a topping process than a fresh launch pad. That does not mean oil can't bounce. It can. It probably will at times. But once the burden of proof shifts like that, rallies are supposed to earn your trust, not receive it automatically. The first magnetic area lower still looks like the upper 70s to me. And if the macro environment keeps softening, I can absolutely see a deeper move toward the upper 60s later on. Not because the world suddenly stops needing energy, but because markets swing from scarcity panic to demand damage faster than people expect. The very price spike that makes everybody bullish can become the thing that crushes demand and sets up the decline. Fresh official energy forecasts actually line up with that possibility more than people realize. The latest U.S. energy outlook says Brent crude likely peaks this quarter and then eases later in the year as supply disruptions gradually abate and trade flows normalize, with the Brent WTI spread also expected to narrow from current extremes as conditions stabilize. Meanwhile, the IEA's latest oil report says global oil demand is now projected to decline slightly this year after a sharp downgrade, with March and April demand already hit by the combination of high prices and the conflict shock. That is not the backdrop of a clean, unstoppable oil bull market. And there's another layer here. The Fed is still worried that higher oil prices can feed inflation and complicate policy, while global organizations are warning that energy shocks are weighing on growth. That means oil is sitting in a nasty feedback loop where higher prices may support the market briefly, but they also threaten the demand side and the broader economy enough to undermine the market later. That kind of setup is exactly how you get a market that spikes, chops, exhausts people, and then drifts lower anyway. So when I step back and look at all three of these markets together, the common thread is not simple bullishness or simple bearishness. It's fake out risk. Gold may still have one more run before a harder reset. Silver may still have one more squeeze before the trap opens. Oil may still bounce, but the broader structure still argues for weakness once the emotional premium fades. That is the game right now. Not chasing the headline, not marrying the story, watching the sequence, watching how price reacts when it reaches the zones that should matter, watching whether bullish news stops producing upside follow-through, watching whether bearish news stops pushing the market lower. Those reaction shifts tell you when the character of the market is changing. And one more thing on gold, because this is not happening in a vacuum. Official sector demand has stayed historically elevated even with prices at extreme highs, and the latest annual gold demand data showed total demand topped the 5,000-ton mark last year for the first time, while central banks still added a very large amount of metal. That matters because it helps explain why pullbacks in gold have not turned into full-blown collapses. There is real underlying demand in this market, not just hot money chasing fear. But again, strong long-term demand does not cancel a shorter-term corrective pattern. It can support the floor without eliminating the air pockets in between. That's also why I think the smartest traders are not asking, is gold bullish or bearish? They're asking, where does the next crowd trap sit? Because that is a much better question. If price can still stretch higher into a major target zone, then the emotional damage gets done at the highs, not at the lows. The people who panic sell too early feel stupid first, and the people who chase too late feel stupid second. Markets are equal opportunity embarrassers. Silver has the same personality problem, only louder. And let's be honest, silver traders tend to make this worse. Every move becomes a revolution. Every dip becomes manipulation. Every rally becomes destiny. That's nonsense. Silver is a beautiful market, but it is still a market. It still overshoots. It still mean reverts. It still punishes certainty. So if this thing does make that final run toward resistance, don't assume that confirms the all clear. Sometimes the market pushes into the obvious zone precisely because that is where the emotional fuel is sitting. And on oil, do not underestimate how quickly the narrative can flip from shortage panic to slowdown concern. We've already seen enough evidence of that. Official demand forecasts have been cut sharply, and even some of the firms that remain constructive are saying their price outlook depends heavily on supply normalization later this year. That means oil is not trading on a clean one-variable story. It is trading on fear, disruption, inventories, diplomacy, and growth risk all at once. In a setup like that, one clean rally can fool people into believing the whole structure changed, when really all that happened was an emotional repricing inside a broader vulnerable pattern. So no, I'm not dismissing the upside bounces. I'm saying the bounces may be the bait. And if you understand that, you stop reacting to every candle like it's the final verdict. You let the market show its hand near the levels that matter. That patience is where your real edge lives. Use this as a framework, not a promise. This is here to help you think more clearly, stay more organized, and avoid getting hypnotized by the loudest voice in the room. It's for education, not personal financial advice. And the market does not owe any of us an easy path just because we drew the lines carefully.